Thank you. Chair recognizes the ranking member of our subcommittee on financial institutions, Dr. Foster from Illinois. You're recognized for 5 minutes.
Thank you, Mr. Chair, and welcome, congratulations, and I hope that you cherish the scars from surviving the financial crisis that we both suffered through 20 years ago. I entered Congress and the Financial Services Committee in March of 2008, where I was right in the front row there, about 2 meters from Ben Bernanke and Hank Paulson, as they came to Congress to ask for a $700 billion bailout, watching the sweat drip down Hank Paulson's forehead. So I hope you don't have to go through that. But you know, one of the Fed's most important roles outside of monetary policy is the operation of the central bank swap lines. And these, as you know, were absolutely crucial in preventing the global financial crisis from becoming a global depression. And I think, to my mind, remains the major reason why the US dollar is the world's indispensable reserve currency, in an area where, by the way, the Chinese are trying to become increasingly competitive. And so the problem, of course, is that right now we have in the White House an occupant who sees his every power as a means of rewarding his friends and punishing his enemies, domestic and foreign. We saw that an example in the Argentine bailout, where he implemented swap lines using the Treasury's Exchange Stabilization Fund. I think he pretty much maxed it out. But to reward one of his MAGA allies internationally with a $20 billion loan at well below market rates, or probably they couldn't get a loan from anyone at that point. And so the question that I have, that when you and the FOMC are operating those lines, particularly in times of crisis, do you see yourself as an agent of the president or as an independent actor?
Thank you, Congressman. I appreciate the question. The swap lines that we put in place in the 2008 financial crisis, like you, I think, played a remarkable benefit in trying to mitigate the risks for the U.S. economy. And it reinforced that the dollar is the dominant currency in the world. Now, my judgment as central bank chief is to let the dollar policy be discussed by the Treasury Secretary and leave that to him. But historically speaking, I think the swap lines played a major role. The dollar liquidity swap lines that the Fed has put in place are about the conduct of monetary policy. So those are independent, but I just want to distinguish one thing. The Treasury has separate authorities and can use the Exchange Stabilization Fund for swap lines that are unrelated to our powers and responsibilities.
Right. Yeah, but the Fed's the big dog in swap lines. I mean, you know, the ESF is, I think it's somewhere a little bit north of 20 billion, I think, is the most that they could deploy, which they did, you know, much, I have to say, not to the benefit of U.S. farmers that I represent, but anyway, he decided to bail out his friend in Argentina. But that was the Treasury, and that was different. You know, so the question is, what happens if there is a crisis and you get a call from the president that says, I got this friend that I want you to bail out or punish by politically allocating those swap lines? Is there an independence there that we have to protect as well?
So the independence in the conduct of monetary policy and everything that comes along with it is independent. But just to go back to the 2008 financial crisis, when all that happened, as you'll recall, the Treasury Secretary and the Fed Chairman, they often had to work in tandem. It's hard to distinguish in crisis times, separate from more benign times, exactly where those roles and responsibilities are. And when we put in those swap lines, when I was a governor at the Federal Reserve, I remember frequent discussions between the Treasury and the Federal Reserve. We have our independent authority, but I don't want to leave you with the impression that in 2008 or 2009 we did that without a discussion with the Treasury.
Okay, well, I just, be very careful of that, because you are going to be coming under extreme pressure. Now, let's say I applaud all of your focus on data, which we talked about when we talked, and in particular your need for better real-time data. You know, the question of whether we could have picked up the inflation earlier with more leading and real-time indicators, I think is a very valid point, and I applaud you for having your committees investigate that. But does this interest also go into real-time regulatory information as well, which I think is really going to be crucial in a world where there's 24/7 banking operations? Banks and financial institutions can get in trouble fast. And so are you also going to be looking at the need and benefit for regulatory data on a faster timescale?
Absolutely. I've only been here for 7 weeks. The focus in those first 7 weeks, I must admit, is making sure that monetary policy gets back on track. But many of these lessons learned, like in data, how do we make real-time decisions isn't just as monetary policymakers, it's as supervisors and regulators. The world, as the discussion about AI suggested, the world's moving faster.
Gentleman's time has
The world's
expired.
accelerating, and the Fed has to move with that speed.
Thank you. Yield back.